Today, I'm joined by Lizzie Ryan and Darrel Connell, managing partners at the Imbiba, one of the UK's leading private equity firms focused on the leisure, education and health sector. Thanks a lot for coming to the podcast.
Thank you very much for having us.
Indeed.
Let's first start with the background of Lizzie and then continue with Darrel and then let's talk about Imbiba.
So in terms of background, how far back do you want to go? I guess my working life, presumably. I mean, I was planning to become an actress and then decided to become a chartered accountant, the obvious route that you go down. So I ended up doing the graduate scheme at Deloitte, partly because I didn't really know what I wanted to do, but I thought it was a bit of an extension of university. And when I was there, I learned about, I guess, the concept of buying and selling businesses from an M&A perspective. Thought it was pretty interesting. Lots of people on my team were moving into private equity and I thought, that sounds exciting. I'll do the same. So I first went to Sonova Capital, which is a sort of mid-market private equity firm. And whilst I was there, we acquired a portfolio company from Foresight Group, learned more about Foresight Group, made a move there, which is where I met Darrel. And then he told me about this really exciting opportunity about going and doing a startup fund, backing mainly leisure businesses at the time. And I thought, why not? I'll jump and go with him.
Okay. What about you, Darrel?
Bit less conventional than probably Lizzie's. I sort of grew up in bars and restaurants. Every summer job, because my father ran bars and restaurants. Every summer job was working in pubs or restaurants or cleaning floors or washing dishes. And then post university, I did a graduate job in the city. But then I read a book by the editor of Wired. This is about 20 years ago, more than that probably. And this is quite early on in the internet, that said that talked about how the internet was going to change the television industry. This is all pre iPlayer, Netflix, all of that stuff. So I joined a startup founded by Yanis Free and Nicholas Enstor, the two Skype founders, called Juice. And I was employee number 2 or 3. I had some share options and I thought I was going to be a billionaire by the time I was 26. Sadly, it didn't play out, and the company crashed and burned and went nowhere. Yanis and Nicholas had already made, I think, $1 billion twice in buying and selling Skype. So I then ended up at Grant Thornton, where then, I guess, a more traditional route in private equity. So a bit of early stage investing in corporate finance, then into Foresight, where I was for 7 or 8 years, kind of running the consumer and leisure investment bit before heading over to Imbiba about in 2016, so nearly 10 years ago now.
Mm-hmm. And what was the origin story of Imbiba? And if we can really get into this, you maybe sharing what exactly are you doing, how has it been, and to make it even more loaded question, like how has your investment philosophy evolved and changed over time?
Yeah, well, so I guess the story of Imbiba sort of had 2 lives in a way. So it was the brand and the name was founded by 2 guys, John and Simon, who and it wasn't a private equity business. It was an operating business, really. And they built and sold multiple pub companies during the kind of gastro bar boom in the UK and in London. So they would set up pub companies, take them from 0 sites to 15 sites, sell them on a Friday, and then start again on the Monday. And they did that 7 or 8 times over. And so there was a sort of platform and a brand. Imbiba wasn't established as a company. It was a sort of website. But it was known to be a kind of operator-led, entrepreneur-led business that curated and started new businesses and got involved in leisure and hospitality businesses. So we wanted to keep that ethos. So we joined Imbiba and we raised our first. We kind of effectively set it up and we raised the first fund in 2018, which was a £50 million fund. And the thesis for the first fund was very much about backing proven brands and concepts. So businesses that might have had 2, 3, 4, 5 sites that are looking to scale from 4 or 5 sites up to 15 sites. So the businesses would be proven in terms of unit economics, profitability, cash flow, but they needed then our money would go in as expansion capital. But crucially, we would help the operator, we would help the entrepreneur, we would try and be everything that private equity wasn't.
A quick pause. I want to talk about today's sponsor, ScalePath, which is your shortcut to the right people. Let's be honest, running a business isn't just hard, it's isolating. Whether you're raising money for your next acquisition or you're scaling through acquisitions, you quickly learn your edge isn't just your capital, it's your people and people around you. That's where ScalePath comes in. ScalePath is a private network of over 2,000 vetted operators across the US and Europe. They're not theorists, they're in the trenches buying, building, fixing, and growing real businesses. So when you book a free call with their CEO, Rand Larson, today, he will personally introduce you to up to 3 operators who actually understand what you're doing and, more importantly, what you're going through. So go to joinscalepath.com and book a free call with Rand Larson so he could introduce you to 3 vetted operators in your area. Now, back to the show.
Because when we built out the team at Imbiba, 60 to 70% of our colleagues are all ex-CEOs, CFOs, property directors, marketing directors. So that was very much the thesis. It was leisure and hospitality was the core thesis back in 2018, and it has evolved now into, as you mentioned, we do a lot in the childcare space. We do a lot. We do in the wellness and healthcare space, but it's typically we are backing 4 walls businesses. So businesses where there is a real estate component and a brand. So whether that's a gym business like One Rebel, or a nursery business like Monkey Puzzle, or Farmer J, a healthy grab and go concept. The thesis remains the same. We're backing great founders on a kind of rollout of a best-in-class brand.
Now, when it comes to the fundraising back in 2018, do you have any fundraising stories? How long it took you to get it done? Was there any challenges, lessons, takeaways from this period?
It was absolutely horrendous. It took us. We had a 50 million hard cap target. We said we would only do it if we could get to 50 million. We got to about 40 quite quickly, and we just could not raise the last 10 million. It took us months and months and months and months. And, I had personally left a job, good, well-paid job, had a young family, hadn't earned any income in 19, 20 months. I mean, it was getting to the point, it was very, very near where if we probably had another 2 or 3 months left at going at it. And then fortunately, we landed a couple of local authority pension funds who took us over the 50 million. I mean, it was definitely the hardest time professionally in my life, but I guess that provides a significant barrier to entry in our business. It's not easy for people to raise a fund, no matter whatever track record they've got. It's a lot of shoe leather. It's a lot of luck. For every yes, you get 100 no's. And that gives you huge empathy. Doing that journey gives you huge empathy in dealing with founders, and as they raise money from us. So immediately when we close fund 1, and again when we close our second fund, I'm already dreading our next fundraise, even though it was 4 or 5 years later. It's mentally so exhausting.
So maybe on your personal story, actually going through this period of, you said 19, 20 months, not having any salary. What was the reaction of your better half, if we can say, you having young kids at home, how hard it actually is? Because I guess there are lots of people who would like to do what you did, but they never do it because all those things you went through. So how was everything at home when you were doing this?
The honest answer is that, I was at a time in my life, I guess reflecting on it now, I was at a specific moment in time where I could do it. Well, we had one young child, and the second child was then born. But, our overhead base, we had a mortgage and all the rest of it, but we didn't have, children at that age are quite cheap, as it were, comparative to when they get older, a bit older. So I don't think I could do it now if I'm all in, we've got 3 children and, our overheads and, life. And my wife is very, very supportive. But it was getting to the point where all of our savings, I was borrowing money off friends to pay mortgages. It was all being burnt down. So it was getting to the point where, okay, that's all very well and good, your experiment of going and raising your fund. But, it was getting very close to the line where I had to call it and go and get a job. But it's looking back on it now, as I say, I think doing it now, I just don't think I could actually do it now.
Now, the fund is raised. What's next? And how are the first few deals going? And How was the first, let's say, maybe 18 to 24 months of operating the private equity fund?
Well, I guess the first thing to say is we're on our second fund now, not our first fund. So I guess I can talk about it in the context of our show focus on the second fund and where we are now versus, or do you actually mean the first 18 months of ever existing Imbiba?
Let's first start with the first 18 months. Once the fresh 50 million fresh powder is on the account, ready to invest, and then let's talk about fund 2. If that's
I suppose in our first fund, We were slightly behind deployment when March 2020 happened. But clearly that was a bit of an obstacle for location-based businesses that were all shut during COVID. So we had 5 investments in the fund at the time. I think for the first few weeks, everybody thought, well, this isn't going to last, is it? You know, things will be open up, things will open back in no time. And then we realized actually it was going to be a lot longer. But in some ways, you know, that created a massive opportunity for that fund. So it wasn't great for our initial investments, but it meant that we then were very active and made 7 investments in a 14-month period on some very decent terms, and will arguably be some of the best investments we made in that fund. So I guess there's sort of two sides to that fund. For the investments we've made prior to COVID, you know, there will still be some great returns on those investments. However, you know, some of them lost nearly 2 years. There was a period of time when people didn't know when they were going to open, where they should be opening, should they open every site in a residential area, because no one's ever going to go back to the office again. And obviously it took, as everyone probably remembers, many, many waves of COVID in different tiers before there was any sort of stabilization.
Okay, you mentioned 7 investments in 14-month period. When exactly was this period, and how intense it was, and how you were able to actually make it happen?
Part of the reason why we made it happen is that, you know, we didn't stop working. So as soon as we were able to go back to the office, we went back to the office. And part of that was to support our portfolio companies, because when they were able to open the doors, they were making their team members go back into the sites and operate the sites. The worst thing we could do was be sat at home behind a screen, not supporting them. So where we tried to, and within all the rules and regulations we were allowed to, we would have face-to-face meetings with people. And that included meeting founders in parks and going for walks. I mean, Darrel, for example, that's how we negotiated the terms on Pete's Pilgrims, because he met with one of the founders, he spent time with him. And I think founders were getting sick of more and more private equity firms only agreeing to, you know, they were looking at sites in Yorkshire, having never been there before and never bothering to go on a site, whereas we were willing to meet with people and engage with them and have those discussions. And I guess the fact that we were so ingrained in the sector and we understood the nuances meant we could also take risks that, say, a generalist investor wouldn't take. We understood what was going on, well, as much as anybody else did, but we knew what good looks like. And so we were able to be creative with the way that we sort of looked and valued companies during that period of time as well.
So when the COVID actually started, like, what was the initial reaction for you, for your team? How was the first few weeks? What did you do? What type of plan you set if you could set any for the next half a year or a month or a week, or what did you do when it all started?
You know, looking back on it now, Mick, I mean, I don't think we knew what was going on. I mean, the whole thing was complete madness, wasn't it? Everyone was like, this is going to last for a couple of weeks. Candidly, it was absolutely terrifying for us, because whereas we had peers that worked at generalist private equity firms and some of their e-commerce businesses might be booming, or this sector might be, you know, in COVID, all of our businesses were shut. They were completely shut. So, and we went through the ridiculous task of modeling every scenario of, okay, if we open up in 3 months, what will the cash flows look like if we do this? And it was all, in hindsight, a complete waste of time, because no one knew. We didn't know anything. It was all just scenario planning, war game planning. Obviously, then there is a lot of, you know, you're dealing with landlords and, you know, government lobbying and all sorts of stuff, really stuff that we shouldn't really be doing. And it was then just, as Lizzie said, it was working with the founders, trying to keep their spirits up, really. You know, these people, I'll give you a classic example. Farmer J was a business we had invested in. Farmer J in February 2020, like, record sales at all of its site. It was at this point a city-based, fast casual business, like absolutely thriving. And, you know, what was going to happen to that business? When's that going to reopen? It's city-based, entirely dependent on office workers coming into offices. So, you know, the founders were working with the founders, trying to keep their spirits up, trying to keep our own spirits up. But it was, I think we shouldn't sugarcoat it. It was very, very bleak.
I think when people got to version 51 of their updated cash flow, they started to give up slowly.
Now, keeping your spirit up, keeping the founder's spirit up, how about the investors? What were the maybe expectations or conversations during this time? Because it was all new for almost everyone.
You know, if I'm being honest, I was a bit worried that we might have our fund gated or something. You know, you didn't know. This was unprecedented times, you know. Our investors were really supportive. They themselves didn't know what was going on. I think as long as you're communicating, we kept communicating with them. We kept telling them what we're doing. We kept reassuring them, and they appreciated that. and there's not much more we could do. But they were really supportive of that. We didn't know how they were going to react. I don't know how I would react if I was them. But they were supportive.
And now when we take this brutal 5-year period of going through COVID and inflation and labor shortages and all that, one thing is the whole portfolio, like for the future accidents like this.
So I guess this comes down to our sort of investment strategy and portfolio makeup. So we've had, especially with our second fund, a lot of our focus has been on not necessarily non-discretionary, but areas where we feel there's more resilience within our subsectors. So, for example, we've gone quite big in the sort of childcare nursery space. Part of the reason for this is if you're in kind of affluent areas of the UK and you've got 2 working parents, you have to send your child to nursery. We focused on parts of it where there's high disposable income and low reliance on government funding. So parts of those areas are very resilient. Then within, I guess, leisure, we've tried to focus on areas where the trends are in the right direction. So health and wellness has been picked up. Consumer spending is down, but spending on gyms is significantly up, for example. So we invest in a business called One Rebel. That the like-for-likes are very strong. There's good growth and momentum in that business. And you could argue that spending on gym membership has almost become habitual rather than a discretionary item.
A quick pause. This episode is sponsored by Spacebar Studios. If you're growing your business, if you want to acquire companies, if you do add-on acquisitions, if you're raising capital from various investors, you already know this. Capital follows trust, and trust follows attention. That's why I'm a big fan of Spacebar Studios. They build newsletters that compound not just clicks, but relationships, credibility, and pipeline. And one of the best ways to build trust is through newsletters. So what is the track record? For example, they took a compliance newsletter from 0 to 115,000 subscribers in 14 months. They grew a hospitality list to 35,000 engaged operators with 5% plus click-through rates. They also helped SaaS and services brands turn gold lists into 7-figure ARR. So a special offer for you if you run a business which does between 1 to 50 million in revenue and you want to build more trust by using email and newsletter. Make sure you go to spacebarstudios.co and book a free call with them. What they do at the moment is the first 6 companies that really book a strategy call this month will get the free custom newsletter built by their team. So go to spacebarstudios.co and book your free call. Now back to the show.
I think it's influenced the makeup of our portfolio, which means that the businesses are more resilient for growth anyway. And then when we do, I guess you can't control any changes that government are going to make, but you can control the types of business you invest in terms of, what's the labour percentage to start with. So food businesses and in general typically have higher labour percentages than wet-led businesses. But equally, we've got to balance that with what does the exit look like and are there buyers in that market? So there's a lot of factors, but I guess where we're focused is, stating the obvious, high margin business where you've got more levers to pull.
Could you give me the overview of the portfolio today? Like how many investments, acquisitions, and how many have you exited, and where are you today?
Yeah, we have exited a few of the businesses actually. In fact, one of the businesses we exited from Fund 1, which was one of the investments we made during COVID into a business called NQ64. That founder, Andy, did an incredible job of not being the opposite of a rabbit in headlights. So rather than freezing, like lots of other people did during COVID, he took advantage of the property opportunity, grew the business very quickly, had great sites on great terms as a result of it. And we were able to sort of exit that business on a nearly 6 times multiple. So that was an amazing outcome for us. It was a great outcome for him. It went very well. Our latest exit was our first investment in our second fund. So that was into a business called Little Houses Group, which is a premium childcare nursery and family members club. We backed founder Charlie Gardner, who had a very strong track record. We'd known him for a number of years. And what attracted us to the business model was, I guess, the revenue visibility. Because not only do you have the childcare nursery, where typically if you sign your child up at 6 months old, you're going to keep them in there till they're 5. Also in the members club, you sell a membership base, and he was able to sell the membership in genuinely about 20 minutes for an entire club. He was just able to fill the place. So we invested into that business, and actually we exited within 18 months. So at a very a very strong multiple again. So there's been some strong exits. I think where we've got businesses and processes at the moment, what we found is the generalist private equity firms just aren't there. So it's very much kind of more specialist private equity firms. There is trade still, but where you might have sent out a mandate on a portfolio company and 15 people might have taken it previously, now that number might be a third, but there are still buyers there.
Who has been the buyer for your portfolio companies so far? Is it like a larger PE firm or family office or competitor? How has it been?
A mixture. So, I mean, our latest one was to a very large private equity real estate fund where we have got businesses and processes, or where we've had approaches. It has been a mixture of trade and private equity, actually quite a lot of overseas international private equity firms. US firms have been getting in touch with more and more of our portfolio companies. So it's good that they are seeing the UK in a favourable light at last.
Yeah, I think, Mick, just to take that a bit further, it really depends what sector you're looking at here, particularly in regard to the UK market. So straight consumer, lower mid-market private equity is a very difficult place to be. So if you go back 10, 15 years, the generalist private equity firms would be very interested in the leisure sector, and there was a long history of that. They are now completely out of that sector. So and that's not just leisure and hospitality, it's consumer across the board because of the negative sentiment, macro challenges. However, certain elements of the sector are very buoyant. So, for example, in the pub sector, if you have freeholds, there's a very, very buoyant M&A market there. So there's a lot of operational, as Lizzie said, a lot of operational real estate funds with a lot of money that are deploying into hotels and clubs and pubs, but you have to own the real estate. That's a key component. But there's been a lot more US interest in the UK in recent times. So, and the challenge for us on exit, or good and bad, is when do we exit? So, for example, there's one business at the moment that has received a number of unsolicited inbound approaches. We're the largest shareholder. We could sell it. If we do sell it, we would have made sort of 4 times our money. But actually, we think in the next 24 months, that could double again. So we're holding on to it. So but then there's other businesses where you sort of realize now is the time to move it on. So to answer your original question of the portfolio, we've got about, I think, 11 companies in the portfolio. In Fund 1, we've exited 4 or 5 reasonably successfully, some more so than others. And then in Fund 2, we've got 6 investments. We've already exited 1 after 18 months, as Lizzie said, very successfully. And what that taught us, the challenge in the private equity industry now, well, across all assets, I guess, all illiquid assets, is returning funds to investors. Investors want liquidity. So, what we found with our second fund, we've got many of our investors in Fund 1 re-upped into Fund 2, but we brought in some new investors, obviously, into Fund 2. And what it showed me is a quick exit in the fund. But we're at the point now where we've made, 6 investments, and we've, in that one exit, we've already almost returned what we've drawn down from our investors. And that just gives you huge amount of goodwill and a huge amount of time and patience.
Question, how do you know when it's like too early to sell? You mentioned one of the portfolio companies, you could sell it now and make like 4x, I guess, multiple of invested capital, but you said you probably shouldn't be doing this and you should keep growing the company. So within the next 18 to 24 months, it could double again. What allows you to say that? And maybe how do you know it's too early to sell a portfolio company?
I think with what we do in the sectors we're focused on, if you can imagine, the companies generate profits from the sites that they operate, right? So there's sales and profits, and so a typical, a Pizza Pilgrims or a Farmer J or a One Rebel might generate per site £500,000 of profit or £1 million of profit. And then we have but sits below that is the head office costs, the head office infrastructure. So, but what we often find is when you've got a critical mass of sites, so let's say you might have 10 sites and then you had a head office infrastructure, the sites that you add from 10 to 20, 90% of that profit from sites drops to the company's bottom line because you already have a set head office. So you have that operational gearing in the business. So the example I gave you is the company, we've got that company is opening 12 or 13 sites over the next 18 months. So, and those sites, if they perform even vaguely in line with the current estate, that will lead to the profitability of the business doubling.
I guess the other point to that as well is the like for likes on the existing sites, because it's about knowing the right time to sell a business. It's when you've still got positive momentum. So it's balancing the two. As Darrel said, if you've got a pipeline of sites is going to open up next year, you want that profit and you want that value. But if the like for likes in your current estate are sort of flattening off / looking like they might start declining, you also want to sell it before it gets to that point. With this business, both of those things are positive. So you therefore have quite a lot of confidence there's a lot of value to add in the next 12 to 24 months.
Now, how has been you've done like 10 plus acquisitions. How has been the deal structure? Do you acquire 100% of the business, keeping the founder on board? How has it been so far?
We have a lot of flexibility in our fund. So we're not one of these funds that has to take a minority or has to take a majority. But a typical investment that we will make is usually a minority stake, a significant minority stake. And it's usually us backing the founders. Sometimes when they are slightly larger businesses, the founders might have actually brought in an MD to run the business and they have more of a creative founder role. That quite often happens over time when they reach their limitations. But our typical deal is we're backing founders. It's a significant minority investment, and there might be a little bit of cash off the table, but it's not such a life-changing amount that they're then not incentivized to grow the business. Because obviously alignment is key for us.
How do you find those great founders who you are willing to back?
So we are pretty much every investment we ever make is directly originated off market. So we do have relationships with corporate finance advisors, but typically we will map the UK market. We will decide on certain subsectors, and then we have a team of 3, and their job is to focus purely on sort of mapping the market and finding who we believe to be best in class brands within those given subsectors. We will then reach out to those companies, and our conversion rate on reaching out is very high. And that is partly driven by the fact that we are so embedded in specific sectors that even if someone hasn't heard of Imbiba, they might go on a website and they'll say, oh, I know that brand, or I've heard of that company. And therefore they're intrigued and they will have a chat. And at that point, it's very partner driven. So we will typically always involve a partner in that first meeting because founders want to speak to sort of the principals in any institution. And we will typically try and meet for a coffee and build a relationship before we even get remotely close to discussing what an investment might look like.
So when we take the investments you've done, has it always been the case where you back the founder and they're actually capable of going through the growth you expect that this company to go, or you have make some changes so far?
Typically, when we get involved, the founder is a sort of jack of all trade, master of none. So they cover a bit of property, a bit of finance, a bit of brand, a bit of operations. And then when we get involved, our capital goes in, and there's generally an upskilling across the management team. So might be bringing in a CFO, might be bringing in an operations director, et cetera, et cetera. But the founder will remain the kind of driving force behind the business. Sometimes we see it that the founder, the business needs what you might call a professional MD. So to come in behind the founder. So the founder will be in charge of growth and new sites development, whatever, or menu or food or whatever it might be. But then there's somebody, at this point, the business might be 30, 40, 50 million in turnover, making 4 or 5 million in profit. So it's a proper company. It's not a startup enterprise anymore. It's not a young, so it often needs somebody with a slightly different skill set. That is a very, very hard hire to make. When we've had success with it, it has transformed businesses. When we've had the opposite of success with it, it has ruined businesses for a period. So it's a very, very difficult hire, but it's quite rare that the founder is the right person to start a business and then be the person that takes it up to, say, 50 million in sales. It's generally quite rare.
Do you more look for like 10 out of 10 founders who run maybe it's hard that they running a poor business, but are you more looking at like the absolute best opportunity when it comes to all the tailwinds, or you're only looking for this like 10 out of 10 operator who could make all the changes when you're coming on board as well?
Gosh, it's a very good question. I mean, obviously there's certain sort of, not box ticking is the wrong word, but there's certain attributes a business has to have for us to invest to start with, I guess, in terms of what the concept is and if it's scalable and does it have the right unit economics. But I would say the founder / CEO piece is probably the most important piece of all of it, because that's the distinction often between success and failure, because that will influence how quickly they're willing to go, the risks they're willing to take, the team they're willing to bring in with them. Are they willing to listen? So I would argue that even if the founder ends up being the wrong person and you bring somebody else in, the person you are backing is probably more important than the concept itself.
And so far, like, what is the ratio on how many deals do you look at? How many founders do you meet? And how many you end up maybe investing? We take like a year or a 2-year period.
So we probably meet, we in terms of inbounds and outbounds, and we would probably get in contact with over 1,000 companies a year. We probably meet about 600 of them, and we invest in 3, 4, maybe maximum. So it's a lot of, as Darrel said, it's a lot of shoe leather. It's a lot of meeting people. It's a lot of coffees. But it's important, you don't know what good looks like unless you meet a lot of people.
And when we take a little later phase, like what are usually, or maybe we can say typical red flags on why you decide not to move forward and you decide to kill a deal?
Do you know what? It's interesting. We do a lot of the diligence internally, I guess, because we understand the sectors that we invest in. So we do external as well, but we spend a lot of time doing internal, especially things around management due diligence and commercial due diligence. And during that period of time, you either become much more confident about a business or you lose a lot of confidence. So it's typically never one reason in isolation. It's usually compounding factors, and they might seem each one individually you could overcome. But all of those factors together, you simply can't. So we've pulled out things in the last, 24 hours, and we've got loads of fees on the clock, and we've poured hours of our lives into it because it's the right thing to do for our investors and for the fund.
When you're looking at deals, how do you maybe distinguish between a good operator and, when we're taking the opposite, not so good operator? What are you looking at?
Well, I mean, we're quite fortunate in the businesses we back that they're consumer facing. So you have all the numbers and all the detail, but I'll give you a really good example. We recently invested in a business on Monday to acquire. It hasn't been announced yet. We're to acquire another business out of administration. It's a pub company here in the UK. This business had 14 sites. And then the business that it was acquiring out of administration had 15 sites. So our money went into that company to acquire the business out of administration. And we spent a lot of time looking and in the venues of both the company we were acquiring and the company that was going into administration. And the operating standards, the staff, the quality of the venues was night and day between the two different businesses. And that tells you, we're in and out of these. We have our own portfolio companies, but when we're looking at new investments, you can go into that. You can do all the research you want online and all the reviews and all the NPS scores and all of that stuff, which you absolutely must do. But actually just spending time in venues, speaking to staff, asking the staff about the management team, asking the staff, you'll get a real sense of the operating standards of the business that way, good and bad.
Now, how is your time spent when it comes to those current portfolio companies, new deals, meeting with the founders? If we take one typical week, and how many of those businesses, companies, founders you're meeting yourself personally, or how is it all set up in your team of you have like 12, 13 people?
We've got quite an unusual structure. Whether it's unusual or not, I don't know. But we have, as I mentioned at the beginning, 60-70% of our team are ex-operators, so CEOs, CFOs, etc., of portfolio of businesses. So we try when we make an investment, the idea is that if it's not Lizzie or I joining the board of the business, it would be one of our operating partners. The idea being that Lizzie and I are freed up to focus more on, I guess, investor relations, fundraising, but also new deals. And then the portfolio side of the business actually handing over to people. I mean, we're a very small team. We're a very close team. Everyone's aware of everything in all portfolio companies, but holding the day-to-day matters with portfolio companies is better done, in our view, so one of our operating partners is a lady called Heidi Duckworth. Heidi used to be in private equity many years ago. Then she set up her own business, a family entertainment climbing business. She built it, scaled it successfully, and then led a trade sale. So Heidi is much better equipped to be our representative on the board of that business. And perhaps Lizzie and I, she's seen the private equity angle. She's also built her own and sold her own business and had private equity backing. So she understands every point. And the same with another one of our colleagues, Andrew Maxwell. It's exactly the same story. So we try and put the best people in the best places.
Now a little like a personal questions about your own, like both Lizzie and Darrel, your own like strengths and weaknesses. You've been doing that for many, many years. What is something maybe you really enjoy doing when doing all this, and maybe some of the things you enjoy not so much but still have to do when we're looking at day to day and actually waking up in the morning and being super excited, versus there are some days that you gotta do some things but you maybe don't like them so much or enjoy doing so much. I hope you understand the question.
Yeah, I understand the question. I think I'd be more intrigued to understand what we say about each other's strengths and weaknesses personally.
So I'll go first, Lizzie, give you time to think of your answer. For me, the thing I enjoy most about it is the smell of a deal. Like if you, if you found something or come across something and you're trying to win that deal and agree terms, that's the bit I really enjoy about it. You either have that or you don't. That's where I think my biggest strength is, and that's almost about getting the deal to sort of head to terms phase. The rest of it, the due diligence and the legals, not overly bothered by. It's effectively a contract race. It's process. And in terms of the weaknesses, I think probably around on the portfolio side, I think to my earlier point, I think there are others in our team that are much stronger than me on that, because they have been in those. They have more perhaps empathy, more patience. We are so all in and invested in Imbiba, and when problems happen with portfolio companies, it can be very stressful, and there are problems. There absolutely are problems, and there always will be problems when you're backing small growth businesses. They are always going to hit bumps in the road. So that would be my two.
Yeah, I mean, not dissimilar in terms of what I enjoy the most. It's definitely the fast-paced, dynamic stuff. I would say, as well, you might disagree, Darrel, I think one of my strengths is negotiating. I think people, I don't know, I think sometimes half the time people don't know how to negotiate on the other side of me. So I get an easy ride when it comes to negotiation. But weaknesses...
How long have you got, Mike?
What would you say is my biggest weakness? I know what I don't enjoy.
No, Lizzie has no weaknesses.
There you go. Answer.
Okay, let's talk about other people. Let's talk about founders and supporting them. I was doing some research and I set up a question like Imbiba is known for helping founders where they're weakest. What are the most common gaps you help fill? Like if we take like post-acquisition.
It's recruitment. It's people. It's people. Getting in good non-executives, getting in good CFOs, good operations directors. That's the single biggest thing that we can help with. I mean, we obviously do a lot around property as well, and help a lot. We have across our portfolio, we have about 400 sites in the UK, so we have a huge amount of data on what works where and what doesn't work. We've made every single mistake going. We've been in all of the wrong places and lost money. So it's almost about saying when best to say no. I mean, founders, like everybody in life, has to make mistakes. But letting kind of the things that you think, God, I'm not sure that's the right decision, but you know what, I'll let it fly because it's probably a bit marginal, but I think it's probably going to go the wrong way, and then it does go the wrong way. Versus some things that you just have to say. Like, I'll give you an example. Property. Opening a site in Farringdon or Spitalfields in Spitalfields or whatever it might be in London, or an area in London that we know has not worked for us in the past, or has not worked for many brands. Just saying to a founder, look, I'm really, really sorry. I know you love that site. I know you think it's going to be great, but we're not doing it because, and if you evidence base it, this is the reason we're not doing it. The site, the Wagamama's up the road, or the Nando's there doesn't do well. So that's probably the biggest thing we do in terms of it's people and the effective deployment of capital.
And when it comes to coaching those founders, if you do that, and if you do it, like how do you make sure you're not becoming like overly involved in the day-to-day, or what is your process or system there?
I mean, a lot of this is actually driven by the founders. You find that they fall into two buckets. they either want to speak to you a lot because they actually haven't had anybody else to bounce ideas off for a long period of time, or they don't. I mean, as Darrel said, we try to just not meddle in the day-to-day operations whatsoever and just help with key strategic pillars such as recruitment, procurement, property, etc. But I think one thing we do with all of the businesses we invest in, as Darrel said, is appoint a non-executive industry chair to the business. We find that itself, a chair can act very much as a mentor as well. That is often a huge support to the founders, and it stops us getting too involved in the businesses.
And I think key to that, Mick, is that every private equity firm puts in a non-executive chair, so it's not very imaginative or innovative, but it very much depends on what that person is and the character. So a lot of private equity firms will look for someone, very good on governance and very good on this, that, and the other. And that, I'm not underestimating that. I couldn't agree more. But we're always looking for people that can really, really move the needle in mentoring the founder or bring the founder along and have that really understand entrepreneurs. And, they might do a day a week in the business with the founder. They can really move the needle. It's just not somebody that turns up to a board meeting once a month and talks about governance and board minutes and all that stuff. That's fine. Those people are 10 a penny. I'll give you a good example of that. So Farmer J was a business when we got involved with it back in the day. It was unbelievable. Top line, doing brilliantly, great brand, great. It was like very exciting, but operationally it was it had a lot of work needed to be done. And we brought in a guy called Andrew Walker, and Andrew Walker was the CEO of UK CEO of Pret during Pret formative years, and was basically lauded as the guy that operationally built Pret. And he came into little old Farmer J and had a transformational effect on the business.
Now, when I say a word incentives, what comes to mind, or if you have to give like a 2-minute presentation on incentives of what you've learned and when it comes to working and motivating and supporting those founders, what comes to mind when I say the word incentives?
All of the founders that we back, in the majority of cases, they own a material part of their business. Some of them own the majority, some of them own a large minority. So they are unilaterally focused on driving equity and shareholder value, and that's very important to us. And we spend a lot of time thinking about that at the beginning of any investment. We say to founders, what do you want to do here? Because do you want to pass this business on to your family? Do you want your son to take it over, your daughter, or your whoever? Or do you want to, if you're taking money from someone like us, we need to drive this over the next 4 to 5 years and then seek a liquidity event. And, every single founder we back is completely motivated by that journey and the liquidity event that comes at the end of it.
So how do you talk to founders about liquidity events without misalignment or misunderstanding? Because the case you said before, where you actually have an opportunity to sell a business today versus to work another 24 months, super intense, high stress environment, lots of pressure to grow the business and then sell it. How do you know the founder is on the same page with this? Because I guess they're often the person who will do the magic if they're motivated and keep doing the work.
Well, I guess the first point to say is that we, from the outset, before we even invest in the company, we have this conversation. I know things can change over time, but we need a way of getting out of a business, regardless of whether a management team wants to. So we've already had that conversation up front about, this is our intention. What is yours? What are you looking to do? So they know that's our vision. There's no point kind of hiding that. Clearly, when you get to those points along the road, people might have different aspirations, and then it becomes a collaborative conversation at the time. But commercially, you can't hold on to a business if a founder doesn't want to be there anymore, and vice versa. The same when it comes to exit.
Yeah, I mean that question, Mick, is you sort of looked at through many different lenses. So, for example, if we have a founder that comes to us and says, "Do you know what? I want to put the business up for sale now. I'm tired. I've had enough. I want to go and do something else in my life." We probably then have to pull the trigger on a process that's to your point, you're absolutely correct. But the example that you cited, which is absolutely spot on, is the company that we had this opportunity to potentially exit and we want to carry on. In that case, the founder wanted to stick with the business, but they wanted some liquidity event themselves. Because they'd been doing it for 10 years, they'd not had any equity. So in selling it now, they were going to do quite well out of it. So, and they were kind of keen to do the deal, but open-minded to not doing it as well. So what we had to do was structure something which enabled them to take a little bit of money off the table now to de-risk them, so we could hold it for another 2 to 3 years. And these are conversations. You have just got to have cordial, respectful, and professional conversations with founders as these things arrive on the way, and be fully transparent. And difficult. Sometimes the conversations are difficult. You're absolutely right. Sometimes you're not 100% aligned, but you kind of have to. You're kind of stuck with each other, so you've got to figure it out.
Now, when you're looking at those different sectors, take leisure, education, health sector, and you look for the next maybe 2-3 years doing plans, you said constantly raising like a fund 3, already working on this. What are you maybe excited about? What are you less excited about? This is maybe an overall question about the market and the opportunities you pursue over the next maybe 2-3 years.
I think the thing that we're less excited about is the macroeconomic backdrop. It is. I mean, I think we shouldn't sugarcoat that. It is difficult. It is a challenging environment. And I think, and then linked to that is the M&A environment. Now, we are, so in terms of new investments and new sectors, we are thinking very, very long and hard about everything in regard to buoyancy and liquidity around when we want to sell a business. Will there be a good exit market for it? So we talked about earlier, there are certain spaces which, for example, childcare nurseries. If you build a great 15-site London-based nursery business that's successful, there will be a plentiful number of potential acquirers. That's not the case in many other sectors. So when we're looking at new investments, we're very, very, very focused on that, because generating liquidity to investors is incredibly important. In terms of things that we're excited about, I think from my perspective, and as Lizzie touched on earlier, we are really the only people in the UK that do what we do. So this does provide us with a significant barrier to entry and, our ability to get into deals ahead of others. So the only people we compete with are the generalists who sometimes wander into our sector. So I think because of the portfolio that we've curated with some of the brands here in the UK that are very highly regarded, it's, I think I'm excited that the brand that we have built is Imbiba, and it gives us that, because ultimately we are offering the commodity that is money. So you need to provide differentiation. You do that by your brand, but so by the team that you put together that has the kind of empathy, emotional intelligence. Because the private equity game has changed, Mick. If you go back 20 years ago, 30 years ago, it was, blokes in suits asking kind of probing questions and pretending like they're the kind of overlords. But it's not that anymore. To get into the good businesses, private equity is the one that has to sell and beg and hustle to get into these businesses. The game has changed, and I think we've got a team that's equipped for the modern era of private equity.
Now, if you're looking at the deal flow, the companies, the opportunities, are there more good and great companies and opportunities to invest in, or there is like surplus of capital which is looking for those opportunities? Like, where are we at the moment?
I mean, to Darrel's point, you're kind of the only people that do what we do. So in time, there's definitely not surplus capital, but there's still an education piece to companies out there that, we're still investing, given so many people sort of backed out. And just because there might be bad macroeconomic headwinds, it doesn't mean they're going to get an undervalue for their business, because good businesses are still worth, a decent multiple. So there is definitely an education piece on that. It's more just in terms of what we do, because everything we do is typically off market. Quite often these businesses aren't necessarily looking to raise funding. So it's our job to convince them that they should, and they should take it from us.
Now, you've experienced this one crazy cycle. What would you maybe say to some advice to a founder who's maybe putting together an investment firm, or someone who hasn't experienced such crazy period yet? Like, how do you maybe prepare for that, or while being in this craziness, how do you survive this? How do you overcome this? You will mess up things, but maybe how do you survive it? Maybe there's some advice from you.
I think the two things are resilience and learning to deal with failure. That's you are constantly, if you're fundraising, as I say, you're 99% no. You hear no 99 times before you hear yes. You just need to be incredibly resilient, not take it personally, and keep going. And then when you're up and running, and in COVID, on difficult times, and when portfolio companies hit because you blame yourself. We run the firm, and if investments, no matter who makes them, we have blessed them, and we've been we have got behind them, and if they don't work, you take it really personally. So you've got to be able to deal with failure effectively and learn from failure.
Once we finish this podcast, what are maybe the next or some of the biggest challenges? You mentioned some of the problems you're facing, whether it's portfolio companies, fundraising. So once we end this recording, what are you starting to work on immediately?
I think the fundraising land, private equity businesses like ours, they live and die on their quality and their ability to fundraise, right? That you're only as good as your last fund. It's not about doing deals. Doing deals, of course, is the day job, but the real thing is fundraising. And I think that, for us, we've done our first fund, we've got our second fund, and I think we'll be, in the next 18 months, turning our attention to our third fund. We'll also be looking at different geographies and different strategies. So maybe setting up operations in a European territory to provide a hedge against the UK economy, but also looking at not just growth equity funds, maybe real estate funds. And so I think building out the firm and the capability to provide a kind of degree of risk, because the fundraising landscape, staying as a single product, single focus growth equity fund in the UK market, irrespective of your performance, good or bad or indifferent, it's a risky place to be, because private equity at the moment as an asset class is having a bit of a tough time. But as we touched on earlier, Mick, in that our LPs, our limited partners, our investors, we've been able to give a bit of liquidity back, and that's that's greatly received. But if you go these bigger mega cap funds, they're not, because of the IPO markets are clogged up and not operating. The liquidity coming back to many limited partners is poor, as poor as it has been in decades.
A question for both of you. What comes to mind if I ask, what do you know now that you didn't know 5-6 years ago? Something maybe obvious.
How tough it would be? No, I'm joking. What do I know now that I didn't know 6 years ago? I think how much you have to adapt to the market. I think I didn't think things would move so quickly, and even just within our investment focus, being nimble and looking at things in a different way, and sort of using the same skill set, but to go into those new subsectors and areas. That's the part I probably didn't know. Which I thought we'd just be investing probably purely in leisure at this point.
I guess from my perspective, the importance of a brilliant team within Imbiba. We've had some bad hires, and the chaos that they can cause, because the way these businesses work, Mick, is that if we have a colleague that's on the board of one of our portfolio companies. They're sort of, whilst of course we're all close to that company, they are the spokesperson for Imbiba on the board of that company. And we have seen examples in the past where people have wreaked chaos and made such poor decisions that has had such long-term impact on businesses. So making sure that we've got our team tip top, and not taking, we're recruiting at the moment. We've been recruiting for 6 months. We haven't found the right person. We will not take them on unless they are absolutely the right person, because the chaos that one person can wreak is quite significant in these businesses.
Okay, I want to wrap up with 2 quickfire questions for both of you. Lizzie first, what is the best investment advice you've ever received, and what is your favorite book?
Best investment advice I've ever received is a slow deal is a good deal. And the best book I've read is $1 Billion Whale recently, which is the story of Jeho Lo. The great thing, do you know that story about how he stole money from the Malaysian sovereign wealth funds and all of this stuff? I mean, unbelievable what he got away with. And the most interesting about that book is that in the world we live in, Jeho Lo is still at large and has never been caught, despite stealing billions of pounds.
So the best advice I would say is stay disciplined. And in terms of books, probably Bad Blood.
Okay, guys, thanks a lot for doing this. I would be more than excited to do it again once you've closed fund number 3. I hope it's soon. So again, thanks a lot for doing this. I had a lot of fun personally.
Thanks, Mick. Thanks very much for your time. Thank you.
Bye.